warriors of price action and guardians of fundamentals. Welcome to Retail Recon. On today's mission, we're debriefing the bull-put spread, also known as the long vertical put spread. This is one of the most popular defined risk, income-focused strategies you can run when you are mildly bullish or neutral on a stock. It lets you collect premium, know your maximum loss from the start, and avoid the unlimited risk selling naked puts. In this episode, you'll learn what a bull-put spread is, how it behaves in different market conditions, when to run it, and key traps to avoid. So gear up and let's go to work. Think of a bull-put spread as a two-layer defense line. One position closer to the action and another in the rear acting as a safety net. Direction-wise, you are bullish or neutral, you expect the stock not to drop hard through your strikes. In options terms, it's a vertical put spread with a bullish bias. Vertical means you have two options of the same type expiring on the same day. In the case of a bull put spread, those options are, you guessed it, puts. In this setup, you're selling a put at a higher strike, closer to the current price, and buying a put at a lower strike, both with the same underlying stock and same expiration. To make the structure absolutely clear again, you sell a put closer to the current stock price, the short put, and buy a put at the lower strike, the long put, further out of the money. Usually, both puts will be out of the money and you are selling a spread for a net credit. That means you will collect the premium up front. The key point here is you're not selling a naked put with unlimited risk. You're capping your worst case loss with the lower strike put you buy. Your maximum potential loss will be known when you set up the trade. You have a perimeter around your exposure. On screen, you have a chart of Visa. We'll use that example to walk you through the complete setup of bull put spread. Let's say you have a thesis, Visa will bounce off 22 EMA and you want to capture that move. You don't believe the move will be strong and you don't believe it will fall below 22 EMA. Direction of the trade is determined and you have decided this thesis will play out in the next 30 to 45 days. Visa is currently trading at 320. How will you select your strikes and the width of the spread? As you probably know by now, the closer to the money, higher the premium, but also the risk. On screen you have an option chain for Visa, DTE 38 days. Stop for a moment and think which strikes would you select. A piece of advice, select strikes based on how strong your conviction is. If your setup is purely technical, set up the higher strike at the level you have confidence in. If you are more conservative, look for low delta, 20 and below. Let's say you selected strike of 310. If you sell a naked put, your max loss is over $30,000. That's a naked put, no armor, no safety net. On the other hand, a bull put spread gives you a predefined, much lower potential loss. If, for example, you sell a 310 put and buy a 300 put, your max loss is around $800, substantially lower as on a naked put. That's on the risk side. Now let's run the math. Let's say that for a 310 short put, you would get 450 credit, and for a 300 long put, you would have to pay 287. That spread would result in a net credit of 1.63. That is your maximum potential profit per one contract. Now let's calculate the exact potential loss based on those numbers. First, width between the strikes, 310 minus 300 equals 10. From that number, you subtract the net credit received. In this case, 163, which equals 8.37. Your max loss for this spread is $837 per contract. When I have those numbers, I always calculate the risk-reward ratio. You get it by dividing max profit with max loss. 163 divided by 837 equals 0.19. That gives you roughly 5 to 1 risk-reward. It is nothing scientific. For me, it is just one of the aspects I consider to see if the trade is worth taking. Usually, I will combine that with probability of profit. Generally, I like to see probability of profit around 70% and risk-reward 3 to 1. If the numbers are not close, I will more likely than not take a pass on the trade. There are exceptions, of course, but those are not based on math, but on the level of conviction. The higher conviction I have, more risk I am prepared to take. Let's finish our example trade with scenarios at expiration. Stock stays above both strikes, you're at full profit, you keep the whole premium. Stock is below the short strike, but above the long strike, you start bleeding money, but your max loss is predetermined. How do you calculate your break-even, not including the commissions? Subtract your net credit from the short higher strike. In this case, 310 minus 1.63 equals 308.37. And final scenario, stock is below both strikes, you are at max loss. A bull put spread is usually a short premium strategy, so time decay works in your favor just like with covered calls. That's the ideal scenario. The stock holds, volatility calms down, and you collect the premium with no assignment. You're not betting on a massive rally. You're betting that the stock doesn't collapse below your defensive line. When the strategy fits, a bull put spread is best used when the stock is not expected to fall sharply in the near term, implied volatility is relatively high, so credit is attractive, you're mildly bullish or neutral, you want the stock to stay above a certain level, and you want defined risk premium collection without owning the stock. Typical battlefield condition, stocks that have just had a pullback and are stabilizing, range-bound names where downside is limited, elevated IV environments where options are expensive and premium collection is juicy, and you prefer relatively narrower spreads with meaningful credit. A bull put spread is defined risk by design, so defensive tactics are limited. In practice, this usually means let it run if the stock stays above your short strike and you're comfortable with the risk, and close early for a small loss if the stock is collapsing toward your spread, you see a higher probability setup elsewhere, and your marginal edge speaking to exit is better than holding. Do not treat bull spreads like stocks and average down when you're losing. You already defined your loss, don't redefine it. Let's recap this mission. A bull put spread is a short vertical put. It's a mildly bullish to neutral weapon, ideal when you expect the stock not to fall sharply. Your max profit is the credit received. Your max loss is the width of the strikes minus the credit. Your break-even is your short strike minus the credit received. It is best used in range-bound or stable environments with elevated IV when you want defined risk premium collection without owning the stock. Core takeaway, the bull put spread is not a silver bullet but a disciplined defined risk weapon. If you respect the structure, size it right, and align it with your thesis, you turn unpredictable premium selling into a repeatable tactical edge. And with that, we close today's briefing. If you find value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.